Hello, today is Monday. It is September 5th, 2022. Today's session is titled Stock Market Downtrend Until Proven Otherwise. And this is your weekend report. Hi, this is Jonathan Gurney, Portfolio Manager at Gurney Financial. Friendly reminder, this post is for informational use only. The views expressed are those of the author Jonathan M. Gurney. This material is not intended to be relied upon as a forecast, research, or investment advice and is not a recommendation, offer, or solicitation to buy or sell any securities or to adopt an investment strategy. In short, we're keeping our clients aware of the things we did this week, the trades we made, and the game plan ahead. Okay, so here's the performance for the week. We're doing this on a Monday because the market is actually closed, but futures are actually open until about 1. So I definitely am keeping an eye on that, watching what's happening under the table here. So the S&P 500 this week was down 3.29%. So this week, and I'm going to show you in the charts, we passed a key level to the downside, which for me meant an immediate sell because I believe it means it's an immediate sell for institutions as well. Again, institutional money controls the market. You can still get bumps from retail, but if institutions are selling, you're going to have a hard time fighting that. And we broke a key level that in my rules is an immediate sell. So we are in cash. Now, that does not mean you just get comfortable there. That is a mistake that I have made way too many times in the past in saying, the market is down significantly. Usually I do a better job of protecting to the downside. Here is the week, as you can see. And here is year to date. It is ugly. Doesn't mean the world is going to end, but there's nothing like price to change sentiment. So when things are going down, people think the market's going to go lower. When things are going up, people think the market's going to go higher. It's just how it works. So, 2 weeks ago when the market looked like it was going to rally even higher, people got super bullish. Well, we lost a key level. Now we probably go lower than people expected. It's just often how it works. Now, we are in a tight range here. That is very important. First, I'll show you our performance in the week. As we stated, up till Tuesday, I was pressing kind of hard because we were right at key levels. We lost the key level. I was out immediately, and you can see I've been in cash since Wednesday, and that saved a decent amount of money. So while I hate losses and it was not fun, we still beat the S&P 500 by 1.91%. I am not happy with this. 4 weeks ago, we were up beating the S&P 500 by 20%. What hurt me was is I got a little bit biased thinking we were just going to tank, and this happened. Hold on. And this happened right here. Boom. Huge move. Put call ratio is very high pretty much this entire time. Seasonality picked up. I actually thought that July would be a good ending to the month. However, we had so many gaps up that I had a hard time adding, and that's my fault. It's some historical moves that we've experienced. Not an excuse. Got to do better. It's a little bit, it hurts me inside of here to know I was beating the S&P 500 by about 20%. 4 weeks ago, I was short through here, actually doing completely fine. And then this rallied and I got stuck because many of the moves happened overnight, which is nothing new in history. It happens all the time. So here's the S&P 500. Now, the key thing that I want you to see is Tuesday, we lost the 50-day moving average right here. And that level was right around 40.17 at the time. Now it's 40.20. When we lost that is an immediate sell for me. It doesn't mean you stay in cash forever, but I'm going to try to prevent further loss and try to protect capital in those situations. I do believe that this is an institutional sell. We keep trying to test the level, 40.20, and I'll show you in a more short-term chart here, 40.20. You can see we keep butting up against this, and it's a wall. Boom, 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 wall down. Here's the range that I think is going to be tough this week. Basically, 39.70-ish. Call it 39.75 to 39.20. okay? And if I show you the chart, so again, 39.75 to 39.20, it's actually a big range. However, if bulls cannot get above 39.40 quick, I think we got some problems. And so I will remain cautious. So objectively, I have to be real. These are one of the most difficult times in trading because, when you see this, long-term, your risk reward is good because the market is down so much. But right now, everything should be treated as catching a falling knife, meaning the market is going down. You have to protect. Don't assume it can't go lower because people are very concerned right now. There are some things that I like to see, like, for example, a high put call ratio, meaning people are very, very negative on the market. People are hedging. People are shorting, think the market's going to continue to go lower. So this red dashed line is there for a reason. It's always there, and we're above 80. So a put call ratio of over 80 is something good that you want to see as a bull, but it doesn't mean that people are just going to blindly buy it. Percentage allocated from National Association of Active Investment Managers is 32.36. So very, very low levels of interest in the market right now, and the people are shorting. So once that flips, for example, if we get above this 39.70, this thing could rally very, very quickly to 40.20, and my guess is it would break to 40.60. So you don't need a bias. You just have to keep taking shots. That's the hardest part in this game, is you have to keep taking shots at key levels. If we test 38.80, let's call it 38.80, that might be an attempt try for me, a small shot. If it goes below, I'm out quick. These are not times to be just throwing huge amounts of money in the stock market. You want to slowly get in, and once we regain a key level, that is what we have not been able to do, is we have not been able to regain and hold a key level. We did break this week 39.30, which was a nice little opportunity, but ultimately we struggled where we needed to break, which was the 40.20. This is the big level. So it's a difficult situation where we are very, very low, which long-term provides great opportunity, but it doesn't mean that people are going to come in and just buy right away. So you have to take small shots. I know it's not fun, but I have to. It's learning from mistakes and saying, it's incredibly low. I beat the market by X. You have to keep taking shots. Otherwise, you'll get so negative, you'll never add, and this type of move happens. We're not there yet. So the point in this conversation is to say, listen, it's ugly right now. The market is in a situation where it's guilty until proven innocent. And I think it'll be proven innocent, at least short term, if we get above 40.20. So the big one short term, in my opinion, is 39.70. We get above there, we've got a shot. Okay, so I'm going to turn on the timer. So 1 second. Sorry about that. There we go. All right. So back to the charts. So here is the big 10, the biggest 10 stocks in the S&P 500. You see this and it's going to be hard to fight. Like, don't fight down moves. They're catching a falling knife, okay? For the week, the actual sectors all down. So here's an important thing that I want you to understand. You hear on television that there's always an opportunity somewhere, and there is. However, it doesn't mean that it's good risk reward. For example, do you buy the things that are conservative just because they will go down less, or do you go to cash and try to prevent a loss? I believe that cash is a position. So for example, when you see this is just saying get out of the way, quit trying to be a hero. Like, here are the conservative areas in healthcare, utilities, even protective areas, consumer staples type areas was still down 2.54%. Okay, so the point being is, just because the market is going down doesn't mean you can just try to throw money in. to conservative areas. A lot of people think that silver is just a good hedge. Here's the reality. The silver is this reddish line. This is over a 20-year period. So when the market is going up, which is this black line, or let's just say it goes down, 2020, was silver a good hedge? The answer is no. Was silver a good hedge in 2008? It was a little better, but look, it still got slammed. So the point in this conversation is when the market is downtrending, there's really not a place to hide beyond cash. Be in cash, wait for us to regain a key level, and then press, because it leads to good things. So I want to teach you that, because you're fighting the trend, and you're also getting sold things that you just don't need. Just be patient. We'll be in cash until we regain a key level, but I got to keep taking shots. But I can tell you, I know several people that are being sold on silver because they live in lower income areas, and this story continues to get sold, and I don't know why, because it is not a very good hedge for the stock market. Just be in cash and wait until we regain a key level, and that key level is 39.70 or 39.40, or excuse me, 40.20 and 39.70. Those are the key levels as indicated right up here in the blue section. So let's see what else we got here. Put call ratio high, volatility still high. Overall, that's kind of what I wanted to go through real quick. Wanted to show you, and also that the stock market is open. So it's good to be in cash right now, but look right where we're at, 39.20. We want to hold 39.70. We want it to get above. Okay. So you can see in the right hand column where I say hold ES 39.20. That's what bulls want to happen, but we are in cash until a key level is gained, and that's either 39.70 or 40.20. So overall, just wanted to get this out to you. It's not a fun situation. I know it's brutal. You're going to hate your statements. You're going to think the world's ending. However, this will provide opportunity once buyers come in. Right now, buyers are not coming in, so you protect capital as much as possible. So not a time to get incredibly bearish, because this could lead to a very, very big rally. In fact, it wouldn't even surprise me for us to hit a new low this year. Hit a new low, potentially go below 3,500, and still hit all-time highs by the end of the year. It's that type of year where it could actually happen. So do not get too bearish, even if that does happen. Again, the S&P 500 averages 12 to 14% a year. This is not fun, but I still have to take shots. What I've not been good at in the past is when it gets down this low, after protecting a decent amount, this time I have not protected very well. The reason I didn't do well is because I was shorting through here. That was a no-no. You don't do that above the 5-day moving average. So new rules. I hope this helps, but overall, not fun looking at statements right now, but hang in there. Keep following the plan. Do not stop contributions, because it's going to kill your plan to stop contributions at the time where you need to be adding. It will completely mess up your plan. So try to stick to it. I will do my best. Right now, the trend is down, so I have to respect that. Follow rules. We broke the 50-day moving average. Don't fight it. So hang in there. We will have better days ahead, but you have to be realistic about where we stand. Sounds good. So one more quick thing. The VIX, we broke this channel and off we go. And it was another reason why I got out of the stock market when I did. So following rules well to the downside, but have to follow rules to the upside. The issue has never really been downside for me. It's adding when key levels are regained to the upside thinking, because the news is always doom and gloom at this point. I have to switch that. I have to really make sure I focus on, was a key level gain. So if we regain 39.70, that's a really good sign. So little by little, right now it's protection time. Have a great weekend.